Indirect cash flow method. The indirect method accumulates only cash paid out to suppliers, which may not include cash paid to customers. This method of CFS is easier for businesses that use the accrual basis accounting method. When using the indirect method, also known as the accrual method, cash flow is calculated by adjusting net income by adding or subtracting differences resulting from non-cash transactions. Non-cash items show up on the assets and liabilities side of a balance sheet, so accountants will identify changes to these items that need to be added back or removed from the data, depending on if they are increasing or decreasing, in order to identify an accurate cash flow. Changes in accounts receivable are, on the balance sheet from one accounting period to the next, must be reflected in the cash flow statement. For example, on December 31, 2021, the book value of AR was $200. However, on January 1, 2022, AR increased to $300. This increase in AR had a negative impact on cash flow from operations, $100, and cash flow from investing activities, $100. If an accounts receivable decreases, more money may have entered the company from customers paying off their credit accounts. The amount by which AR has decreased is then added to net earnings. A decrease in inventory would be added to net earnings. Credit purchases are reflected by an increase in accounts payable on the balance sheet, and the amount of the increase from one year to the next is added to net earnings. To give a net increase, inventory is reflected on the balance sheet as an asset, so depreciation of that asset would decrease net earnings. Net income cannot be increased by using inventory because inventories are reported as assets on the balance sheet. The same logic holds true for taxes payable, salaries, and prepaid insurance. If something has been paid off, then the difference in the value owed from one year to the next has to be subtracted from net income. If there is an amount that is still owed, then any differences will have to be added to net earnings. The following equation is used to calculate net income using the difference in value of investments. Net income of current assets, current liabilities, investments. Income statement. The income statement is a financial statement that describes the revenues generated by a company and its expenses. In this case, the income statement will show total revenues and total expenses for one period. The difference between these two numbers gives us the cash flow for one period. The cash flow is calculated by subtracting all expenses from all revenues in order to get the net profit, which is calculated by subtracting all expenses from revenues. Indirect cash flow method. The indirect method is a system for measuring cash flow by using net income to estimate lost cash from transactions not involving money. Non-cash transactions show up as increases or decreases in assets and liabilities on the balance sheet. This is how the accountant calculates an accurate net figure that can be used to represent any cash inflow or outflow of the business in a given accounting period. Changes in accounts receivable are, on the balance sheet from one accounting period to the next, must be reflected in cash flow. Assets, liabilities, equities. The change in AR from one period to the next is equal to the change in receivables minus the change in payables. Accounts receivable payables equals accounts receivable payment. What about changes in a company's inventory? Here's how they are accounted for on the cash flows. An increase in inventory signals that a company spent more money on raw materials. Using cash means the increase in the inventory's value is deducted from net earnings. A decrease in inventory would be added to net earnings. Credit purchases are reflected by an increase in accounts payable on the balance sheet, and the amount of the increase from one year to the next is added to net earnings. The same logic holds true for taxes payable, salaries, and prepaid insurance. If something has been paid off, any changes to the amount owed between one year and the next effectively reduce net income. If an amount is still owed, any change in the amount will result in an increase of net earnings. Net income is not a constant. It will fluctuate throughout the year based on changes in both business revenue and expenses. Limitations of the cash flow statement. Poor cash flow does not always represent a red flag. It might be a sign that the company is investing in their future, which would be good news in general. A cash flow statement is great for analyzing changes in cash over a time period and can help investors establish if a company is on the verge of bankruptcy or success. The cash flow statement should also be considered alongside other financial ratios, such as return on investment and fixed assets, to determine if the company is reliable enough to invest in. The cash flow statement is a very important tool in evaluating a company's financial stability. A company's ability to produce cash flow will determine its future success or lack thereof. The most important objectives of the cash flow statement are to identify which areas of the business generate cash and whether or not those areas are increasing. If a company generates more cash than it spends, it will have positive cash flow. The cash flow statement is a subset of the income statement, which is the first section of a company's financial report. The cash flow statement reports how much cash was generated and spent by the company during a certain period. Please join us next time on Basic Accounting. Please don't forget to subscribe, like, and share so that when we release a new video you are updated. Thanks you for watching.